In this video, I thought I'd give a general overview of some of the high-yielding dividend purchases I made this week in my high-yield dividend portfolio. What I generally like to do during a typical week is invest a modest amount into a handful of several different positions. I don't normally dump thousands of dollars into one position on any single day. So I'll go ahead and post a handful of the transactions that I made this week and go into more detail on a couple of the holdings. I'll discuss why I'm choosing to buy more shares of these investments right now and the risks associated with holding them. As always, do your own research before considering any position to make sure that it matches your investing style and risk tolerance. The investments I make during a typical week can range between low risk and very high risk, so do your own due diligence before investing. But with that being said, let's go ahead and get started. The first stock I've been buying more of this week is VICI Properties, ticker symbol VICI. This week I picked up 5 additional shares at $32.60 each. They describe themselves as an experiential real estate investment trust that owns one of the largest portfolios of market-leading gaming, hospitality, wellness, entertainment, and leisurely destinations. They currently have 93 properties in their portfolio across the US and Canada, which includes hotels, retail outlets, golf courses, and entertainment venues. But VICI is most well known for their casino properties on the Las Vegas Strip. They own a lot of the most popular resorts in Vegas, including the Venetian, Caesars Palace, the MGM Grand, and several others. Roughly 48% of their portfolio is made up of Las Vegas properties. This is one of the lower yielding and lower risk stocks in my portfolio. My dividend strategy involves buying dividend stocks that yield a minimum of 4%. If a stock yields 6% or less, then it must offer consistent and appealing dividend growth. Most of what I own are the higher yielding investments, but VICI is one of the lower yielding ones, although it's still offering a yield of about 5.5%. As of their most recent quarter, their adjusted funds from operation had grown by 5.6% year over year, and their AFFO payout ratio was 74.5%. That's pretty conservative for a REIT in terms of a payout ratio. Most like to fall between 70 and 80%. As I always like to highlight with VICI, they have some pretty significant advantages compared to other REITs that exist. Because they own much larger assets, they've been able to grow their rent at a much faster rate, roughly 3 times faster compared to the typical REIT. The average tenant of a VICI property is locked into their lease for 40 years, which helps predict cash flow. Most of their tenants are very heavily regulated and they have very high restrictions, which makes it unlikely that they'd want to find a different landlord. From a dividend perspective, they've offered a compound annualized dividend growth rate of 7.4% since their IPO, far ahead of other experiential REITs and most REITs in general. Now, there has been one growing concern that people keep bringing up, which is that tourism has started to slump in Vegas this year. Compared to this time a year ago, the number of visitors to Vegas has dropped roughly 5.5%, raising some concerns. While this is a trend that'll need to be monitored, keep in mind that in 2020, VICI was still strong enough to collect 100% of their due rent during the COVID lockdowns. And it took Vegas years to rebound from that, and their dividend was still safe during all that time. So in order for their dividend to be at risk, we'd have to see tourism fall significantly more in order for it to be a possibility. None of their major tenants are showing signs of any kind of stress as of right now, which is a great sign. The next position I've been buying more of is PTY, which is the PIMCO Corporate and Income Opportunity Fund. I bought 10 additional shares of this fund on Wednesday and at a price of $13.76. This has always been a very small part of my investment portfolio, with PTY representing a little under 3% of my total holdings. According to this fund's page, it says, using a dynamic asset allocation strategy that focuses on duration management, credit risk analysis, risk management techniques, and broad diversification, the fund seeks maximum total return through a combination of current income and capital appreciation. Under normal market conditions, the fund seeks to achieve its investment objective by investing at least 80% of its net assets plus borrowings in a combination of corporate debt obligations of varying maturities, and also other corporate income-producing securities and income-producing securities of non-corporate issuers. That includes U.S. government securities, municipal securities, and mortgage-backed and other asset-backed securities issued on a public or private basis. There are a lot of choices in terms of PIMCO funds that pay high monthly distributions. You likely know that I also hold PDI, which is their dynamic income fund. This one is also really popular among people who want high monthly income. And although I still like PDI, and I think the risk-reward trade-off is still appealing as a small part of my portfolio, I think PTY is a safer option for several reasons. It uses about 65% less leverage than other funds by PIMCO, including PDI. Another thing I like about PTY is that it's been doing a lot better with NAV recovery this year. This is because, unlike PDI, it's more diversified in terms of its holdings. It has a lot less exposure to non-agency mortgages, which PDI is full of. It holds mostly high-yield credit bonds, emerging market bonds, and a decent amount of investment-grade and government holdings. It does have a history of occasionally reducing and growing its distributions over time, so it doesn't have that perfect dividend streak that PDI has. But PTY has been around much longer, and it's done pretty well over the past 2 decades. With dividends reinvested, this closed-end fund has delivered an average annual return of 10.97%, which is great when we consider it's basically been pretty flat in terms of share price. Now, obviously, you might not be reinvesting the dividends if you're living off the income, but it shows you that you can still get good returns that match or even beat the market with these higher-yielding positions. And one more thing I bought recently was QQQI, the NEOS Nasdaq 100 High Income ETF. I just picked up another 4 shares of this ETF at a price of $51.50 each. This is one of the highest yielding investments in my portfolio, as it currently has a yield of 15.35%. It's an actively managed ETF that seeks to achieve its investment objective of prioritizing income by investing in a portfolio of stocks that make up the Nasdaq 100 index. It uses a covered call strategy that consists of written call options on the Nasdaq 100 index. QQQI generates high monthly income from the premiums earned from the call options as well as the dividends received from the fund's equity holdings. Because this is an actively managed fund, it can employ different strategies depending on the market. For example, they can, under certain circumstances, enter a call spread strategy where they purchase long calls in addition to written call options. They can also try to earn income in a tax-efficient manner by utilizing index options such as call options that qualify as Section 1256 contracts. QQQI is the Nasdaq version of my favorite high-income ETF, which is SPY-I. I've been in the process of slowly building up a bigger position in each of these holdings as I've continued to be really impressed with not just their high yields, but also their share price gains for covered call funds. As I recently showed in a previous video, there's 2 really good things that make this the best Nasdaq covered call fund out there, in my opinion. It offers one of the highest yields when compared to QILD, GPIQ, and some others that exist. But it's also been one of the best at share price growth. It's why I've never invested in QDTE, which is Round Hill's synthetic covered call fund on the Nasdaq. This lackluster share price recovery after a bad decline is what's been making me hesitant, but the NEOS fund has been much better at making gains. So that's just a snippet of what I recently bought last week. I bought a couple other positions on that same day, but these were likely the most interesting. Let me know if you hold any of these funds and if you've been buying more recently, or if you think there's better alternatives to what I just bought. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.